So this past Wednesday, September 17th, the Fed lowered the federal funds rate by 0.25%. So most people think that mortgage rates, if they were at 6.375 before Wednesday, that they would be at around 6.1 after Wednesday. But you got to remember that the Fed is not lowering mortgage rates. They don't have the ability to lower mortgage rates directly. What they're lowering is called the federal funds rate. It's a rate in which banks borrow money from each other overnight. That rate affects credit cards, lines of credit, car loans directly. But as far as mortgage rates goes, mortgage rates are based off of certain bonds in the bond market called mortgage-backed securities. These mortgage-backed securities behave no different than a stock in the stock market. So every day the price is constantly changing. The best instrument to follow to get an idea of what mortgage rates are doing is the 10-year U.S. Treasury. And what you'll notice is at the very beginning of August, the 10-year U.S. Treasury dropped quite a bit, and then it did it again in September. The reason for this is because it basically these bonds started pricing in the likelihood that the Fed was going to lower the rates. So essentially, the rate cut was already priced in to these mortgage-backed securities a month ahead of time. And actually, after the Fed cut the rate and spoke, mortgage rates actually got a little worse because the rhetoric from Fed Chair Powell was that this was a one-time rate cut, essentially, and that it wasn't necessarily going to be ongoing. And the markets expected that this wasn't just going to be the only rate cut, that there might be more. So mortgage rates actually got worse after the Fed cut the rate. So mortgage rates actually got worse after the Fed cuts the federal funds rate by 0.25%. So I hope this better explains why mortgage rates didn't drop after the Fed cut the rate and why they actually got worse.